Welcome to Chapter 9, which focuses on basically property, plant, and equipment. Um, Today, we're going to be looking at Learning Objective 1 regarding plant assets, how we actually do the accounting for them. And then Learning Objective 2 is about depreciation on those plant assets. So we're going to be focusing on that today. It's actually the bulk of what we need to do is in the beginning part of this chapter, which is great. So Learning Objective 1 starts off about plant assets. Is it interesting that the slideshow is wrong? How they recognize accounts receivable? Isn't that nice that they start off the slideshow incorrectly with a heading, but they get this right. But it's actually about plant assets and how they actually recognize plant assets on their books. So property, plant, and equipment, remember, physical substance, right? Property, plant, and equipment are assets that are long-term. They're used in the business. They're not intended for sale. They will help the company sell products or services. So they will provide a service to the company for a period of time, right? That's the useful life of the asset. And then they will go through a process that we will talk about in Objective 2 in terms of they depreciate during that useful life. But our focus right now is when you look at property, plant, and equipment on the balance sheet, you'll see the property, plant, and equipment account, and you'll see a number on the balance sheet. How the heck do they get that number? Right. And that's what Learning Objective 1 is really going to be teaching us. Certainly, property, plant, and equipment are really critical for some companies more than others. So if you look at, clearly Wendy's, they own, lots of property, plant, and equipment because they mostly own all their buildings. There's tons of property, plant, and equipment inside, from the refrigerators and freezers to all the stoves, ovens, fry things, the wonderful machines that make the Frosties, which I love. All of that's probably plant equipment, tables and chairs, the signage that's there, all probably plant equipment as well. For airlines, a lot of their assets are probably plant equipment because the vast majority of the time you can't have an airline without an airplane, or lots of them, in fact. And so they cost a lot of money, and for the most part, that's the biggest asset that's going to show in an airline. Other companies don't need as many property, plant equipment. So when you're looking at the balance sheet and you see a property, plant, and equipment account, like equipment, for example, how do they come up with that number? Well, they follow the historical cost principle, okay, which means, basically speaking, they have to record their assets at the cost, what they actually paid for them. So this is going to be the focus of this objective. How do we know what the cost is? Okay. Well, the cost is all they spend to get it ready to use. Okay. And that's what you're going to be learning about. Very, very interesting. We will talk a little bit about revenue and capital expenditures on a future slide. They do introduce this early on, indicating that there's some costs that we will expense immediately when we say we repair an asset that might have broken down temporarily, versus actually fixing up an asset so it actually lasts longer than we thought it would. And that's going to be a capital expenditure. So we will revisit these concepts on a future slide, so hang in there. But let's focus on historical cost and what we have to put down on our books when we buy a building or a piece of equipment or something like this. So certainly we are paying cash, but we're not only paying cash, we're paying other types of things as well to get things ready for note. But there is something called a cash equivalent price, um, which we have to look at as the fair value of the asset. And that's going to be part of our determination. When you look at each individual asset account, we're going to start with land and go through a series of specific accounts. Land is something that lasts forever. Okay, the earth has been around for some time, I hear. And so, land we assume is always going to be useful to a company. And so land is in this weird category where it has a unlimited useful life. But how much does it cost? Well, when we actually buy land, um, what do we actually put down for the actual cost of the land? Well, it's not just the price of the land, but because we are owning land, we have to go through a process of what we call a closing, which basically is a legal recognition that you're the new owner of the land. And that takes place through the courts and the registry of deeds, where you are recorded as, well, the registry, you are recorded as the owner of that land. That usually takes a couple of things. First, you are going to do make sure the title is available so you can actually own the land, that the title of the land needs to be available for you to own. And then, of course, you're probably going to need to have an attorney help you through that process and all that. So there are closing costs that are involved in purchasing land that are going to be part of the land account. Okay. Often when you're buying land, you're buying it from someone else normally, and brokers are usually involved for real estate transactions. And so whatever you pay in a broker's commission is part of the cost of the land. Okay. And so that's going to be included. Sometimes you might be purchasing a piece of land that, in order to actually get the title, to actually claim ownership, you might take responsibility for back taxes on the land, or other liens, legal obligations of the previous owner that you assume that you're going to pay off. So any accrued property taxes that you're paying, any other back liens on that land that you pay, becomes part of the cost of the land. Okay. So when you see land as an asset listed in the property, plant, and equipment section of the balance sheet, there's clearly a lot of costs involved. It's not just the cash price of the land. There's a lot of all these other costs that are involved that are part of the cost of the land. Matter of fact, anything that we spend to get that land ready to use is going to be part of the land account. So here's an example of a manufacturing company who acquires a piece of land for $100,000. Now, on this land that they just bought is a old dilapidated warehouse, so it's not usable. And so what they have to do is they actually have to raise it. And so what that means is they basically take it down, they demolish it, take it down. That raising is necessary in order for them to use the land. So this part of this money that they spent to take the old warehouse out is going to be part of the cost of the land. Why? Because you need to do that to get the land ready to use. That's the standard, ready for use. So that's an additional $6,000. And then, of course, they had to pay an attorney's fee and a broker's commission. So they ask you, what's the amount that's going to be the cost of the land? Well, everything that you paid to get the land ready to use, which is clearly the cash price of the land, how much it cost you to clear the land, to get it ready for use, your attorney's fees, and your broker's commission. So every single part of this transaction is going to be part of your land account. So the cost of land is really $115,000. This is what's going to be debited to the land account. Remember, land is an asset. You'll be debiting these assets when you buy them. So this is interesting to know. This is what you have to know. This is what shows up on the balance sheet as the value of the land, is what we actually paid for it to get it ready for use. There's another account that I don't know if you are familiar with, but there's an account called land improvements. So we have to separate things. Okay, land is land, period. Anything on that land is going to be separate. One of the things that are going to be on that land is something called land improvements. Land improvement would be like a parking lot, fencing, sprinkler systems, lighting, things along this line that need to be erected as part of that. So this is going to be part of our land improvements account. Okay, believe it or not. Very interesting. But the thing is that even if you have, if you put a parking lot on part of that land, or if you put a fence up around your land, then you're going to have to calculate the fact that it's not going to last forever. In other words, it's going to have a useful life of the business, in which case it has to be replaced, right? Repaired or replaced, mostly replaced. Parking lots are, they might not look like much, but they take quite a bit of a beating, not just among the use of it, cars and trucks and so forth going on all the time, but the weather, the expansion and contraction, the heating and the cooling, cracks a lot of the asphalt and other things that are used to make a parking lot. So you have to maintain that, which is great, but eventually it's going to fall apart. You're going to need to actually have a new parking lot. So that's going to be its useful life. Same thing if you have a fence around your property, fences are not going to last forever. Okay. And so you're going to have to figure out exactly, right, what is the useful life of the fence? Because at some point in time, that fence is going to need to be seriously repaired or replaced. So this is one of the things that have had to happen. So if you have a limited life, that means that asset is subject to depreciation. Depreciation only happens in property, plant, and equipment accounts. It doesn't happen for land because land is always useful. We can never measure its useful life, so you can't depreciate it. But in the case of a parking lot, we know roughly from past experience, there are many parking lots that have been built over the years. We know that most parking lots will last, say, 10 years, 15 years, in which case they're going to have to be replaced. They're going to be torn up, retarred. Same thing with fences. Fences have a useful life, say, between 7 and 10 years. And so after that period of time, very likely you're going to need to replace that fence. So because they have a useful life that can be estimated, you can actually depreciate the cost of these over that period of time. Okay. And that's basically what depreciation is really about. Allocating the cost of the asset over a long period of time. It's a long period of time because their lives are measured in years. They're measured in years. And so it just takes a long time to use them for business purposes. So this is the land improvement account. Another account that's separate is buildings. As a matter of fact, when you actually go ahead and buy a building with land, you actually have to put those in two different accounts. The land goes in the land account, the building goes in the building account. Okay, you actually have to separate how much the land really cost you versus what the building really cost you. You don't have to do that, but you have to understand that. So the buildings account is really all the costs related to a building. And there's two things that you can do with a building. You can buy an existing one, or you can build one, right? If there's none there. So let's start with buying an existing building. Well, there certainly is going to be a cash price for the building, no doubt about it. It is property. So in order for you to actually take ownership, there is going to be a closing cost. It's going to be a legal type of process in order for you to take title and for that to be recorded as in the registry of deeds as you are the legal owner. That costs money with attorney's fees, title insurance, other types of things. And of course, if you're buying a building, that person is represented usually by a broker, and so you're going to be paying a broker's commission. All of that is part of the purchase price of the building as well. Some buildings are very old and they need to be redone. They have to get set up to the current standards, and all parts of the building code are evolving all the time. So you have higher standards for electrical. You have to have, smoke detectors, fire, other types of alarms, carbon dioxide stuff. You have to have handicap accessibility to buildings. And so what happens if you bought a really old building and, well, you got a lot of work to do, right? You're going to have to remodel that particular building. All that remodeling becomes cost of the building because you have to sort of bring it up to date to the current standards and the current codes and the law. So everything, and you have to do that before you can open it. So obviously it's clearly you have to do it before you're ready to use it. So it falls into that category as ready to use and thus part of the cost of the building. Sometimes you might need to repair or replace very important parts of that building, like the roof. Maybe some of the floors need to be replaced. Certainly the electrical, the wiring, the plumbing, all that has to be up to date. And if you need to repair it or replace it, that's part of the cost of the building. Anything you need to do to get the building open, literally, is part of the cost of the building. Well, what if there's no building there? Well, that makes it more fun, right? Because then you have to hire an architect firm to design a building and get it ready for construction. So you have a ton of construction costs. You've got permits to apply for. You've got architect's fees to pay. You've got excavation costs, so they can dig the ground and so forth and so on. All of those are part of the cost of the building, okay, to construct it. So lots going on in the buildings account when you actually look at it. The equipment account is also probably, it's part of PPE. It's a very important asset. Most businesses have equipment. And so when you look at the equipment account, how do they justify the number next to it? Well, it's all the cost of the equipment. Again, it has to be ready for use. It has to be ready for use. So it's not just the cash price of the equipment. Equipment falls, because of the product, it falls under the taxation laws. There's usually sales taxes on a lot of equipment. So it's not just the cash price, but the sales tax on that price. You're not buying equipment from your neighbor. Usually buying specialized equipment from all over the country, all over the world. So you have all those freight charges that are part of it. You probably you should have insurance on that freight. So in case anything happens, you are covered. That you own the asset; it's yours. And then once it gets to your place, you're going to have to assemble it, install it, test it. In some cases, if it's a brand new piece of equipment that no one's used before, training people to use it becomes part of the cost of getting it ready to use. Okay. And so anything you have to spend to get it ready for use is part of the cost of equipment. Even, for example, if you have new HVAC systems, heating, ventilation, air conditioning systems in buildings, some old buildings are retrofitted. When you buy that equipment, it's a lot of money already, but you might need to build a special platform, maybe a cement platform, in which outside of your building that needs to house those units. That's also part of the cost of the equipment because you needed to do it to get it ready for use. So the standard is anything you need to do to get it ready for use is going to be part of the cost. So here's a great illustration here about a company that buys a truck. They bought the truck for $22,000. Must be a pretty small truck. They have sales taxes on the truck of $1,320. They spent $500 to paint and letter it. They spent $80 on a motor vehicle license, and they bought insurance. So what's the actual cost of the truck? Well, you had to pay cash for the truck, and you had to pay the sales taxes on that. So those two are definitely part of the cost of the truck. One of the questions is, would UPS or Amazon send out a truck without it being appropriately painted and lettered? No. So oftentimes painting and lettering for businesses is part of getting it ready for use. They don't want to have this undescript truck sort of roaming around. They want it to be identified appropriately as all its vehicles. A motor vehicle license is not necessary because the truck doesn't drive itself. I guess I'm talking in the wrong age of Tesla, right? Where we will be having self-driving trucks eventually. But the motor vehicle license is not to get the truck ready, it's to get the driver ready. So the license itself would be an expense. It wouldn't be part of the cost of the truck. And anytime you buy insurance, it's prepaid insurance. Well, doesn't matter what you're insuring, it's still prepaid insurance. So the actual cost of the truck is $23,820, the cash price, the sales tax, and the painting and lettering. This is what would be in the books as the cost of the truck. This would be debited to the truck or equipment account. Okay. So the journal entries for this would be a debit to equipment for $23,820. The license, like I said, is an expense. The license is to get the driver ready, not to get the truck ready. And the insurance is prepaid insurance. And so even though they spent $25,500 in cash on all of this, $23,820 is specific to the truck. And so that's what gets debited in the equipment account. Fascinating. I know you're thinking. One thing to keep in mind is that things will need to be repaired. Anytime you buy a truck, for example, there's certain things that are necessary. You need to change the oil, right? You're going to need to, the tires aren't going to last forever. You're going to need to change the tires. You're going to need to change the filters, etc. That's simply ordinary repairs. Even if you bought a piece of equipment, even an air conditioner or whatever, there's certain things you have to do to keep it working, right? That's part of its useful life. So it's simply expensed as maintenance and repairs expense. However, what if you change its useful life by increasing its efficiency or its capacity? Well, then you've actually had what's called an addition and improvement. This is actually considered a capital expenditure. So let's say that truck broke down and I had to rebuild the engine. Well, rebuilding the engine is basically giving the truck a new engine, and which means that new engine can mean the truck can last longer than we expected. So in essence, we change its useful life. So the engine, the cost of that engine would simply be debited to the truck account or the equipment account, wherever we had, because now we've extended the useful life of the asset. We thought we were going to use that truck for 5 years, but now that it has a new engine, we can actually, we're going to keep it for 7 years, assuming we change the engine sometime along the line that we used it. So, basically that's the difference. That's the difference. Ordinary repair is expensed, but if the useful life has improved, it's an addition and improvement, and the actual asset's going to be debited. Lots of fraud going on here. I think you've had your share of fraud lately. A lease. A lease is interesting because do you actually own the equipment? No, you're renting it. You're renting it. how does GAAP, Joint Accepted Accounting Principles, want us to deal with the lease of a lot of equipment? And a lot of companies lease equipment. I mean, a lot of the planes that airlines have are leased. A lot of the trucks that even UPS or whatever are leased. So what do you do with leased equipment? Well, technically it's a wash. The asset itself is canceled out by the fact that you owe the money on the lease. So the liability and the assets, in essence, cancel each other out. And so in general, GAAP does not require us to report it on the balance sheet that we're leasing, but we do have to put it in the notes on the financial statements that we have this amount of equipment under a lease agreement. Okay. So again, that's a very interesting concept that you should probably know about. Okay, and we're done with learning objective 1. How did that go? Woo! We all feeling okay about our historical cost? All right, I hope no one gets historical about it. But we're gonna move on. So now the heavy stuff. Hey, Trev, good to see you. The heavy stuff now is depreciation. Okay, so let's start it. So like I promised you, learning objective 1 and 2 are the heavy hitters. So learning objective 1, we figured out what the cost of the asset is. Well, we also have to figure out as part of that how long we're going to use it, right? What's the useful life of that asset? So if I have a pizzeria and I buy a pizza oven, I'm going to be using that oven every day. It's not going to last forever. So it's going to have a useful life, say 10 years. It's definitely helping me sell my pizzas and my subs and other types of things, right? Because I use my oven to cook them before I sell them. So it's definitely related to me generating my revenue. It's very important to that regard. And so it's subject to depreciation. Depreciation basically is a process of allocating the cost of a plant asset as an expense over time. Okay, it's we've used up a portion of the value of that asset to help us sell something. So in essence, expense recognition principle comes in. We have to match the expense with the revenue. So if I didn't cook my pizzas, I couldn't sell them. So that pizza oven is directly related to me selling my pizza. So thus, I can depreciate my pizza oven as part of that. It's part of my expenses for that month because it helped me generate revenue. And so this is basically what depreciation is about. It applies to all the accounts that we looked at except land. Land does not depreciate. It does not have a useful life. It is limitless. Okay. The land you're standing on was here 1, 2, 3, 4, 5, 600 years ago, maybe longer, probably longer, right? Thousands of years ago. It's always useful. The land itself is always useful. It's different if we were a natural resource company. Let's say we were a mining company or a logging company or an oil company. Then the land, the reason we bought the land or we own the land is to generate revenue from. We pump oil, we get minerals out of the ground or gold out of the mountain, or we grow trees and cut them down and sell them. That's different. Land, in that sense, land is subject to something called depletion. But that's only for natural resource types of companies that I just described. For you and I, that if we might own a barber shop or a pizza shop, it's not. It's totally useful forever. And so it's not subject to depreciation. Okay. All right. So a few things you have to know in order to understand depreciation. The first thing we've already learned in learning objective 1, right? What is the cost of the asset that you just bought. Okay. The second thing was also mentioned in Learning Objective 1. How long are we going to use it? How long are we going to use it, right? Until basically it's in disrepair or obsolete. And then the third question that you haven't heard about yet is when we're done using it, will it have something called a salvage value? Some books call it a residual value. But when we're done using this asset at the end of its useful life, will it have any value left in it? Okay. Now, some assets will. The truck, for example, will have some type of salvage value. You know that because there's a lot of former police cars that are being driven by people. People will buy a former police car and drive it around as their personal car after the police are done driving it into the ground. So clearly that asset had some type of residual value or salvage value once the police were done with it for that period of time. So they have to mark that down. However, computer equipment, no one wants to own a 4-year-old computer. So very likely computer equipment has zero salvage value at the end of its life. Because literally you wouldn't be able to give it away. I mean, even if you gave it away, you get dirty looks even from relatives. Right? Why is this person giving me a 4-year-old computer? So salvage value could be zero for some instances, but in many instances, it's going to have some type of small value at the end. So these three concepts are important to understand depreciation. The cost of it, how long are we going to use it? Useful life is going to be in years, mostly. And once we're done with it, is there a salvage value to it? Again, for some assets, yes. For some, no. The big winner in how depreciation is done is the straight line method. There are a few different methods. The straight line method is clearly the winner. It's the most popular method of depreciation. It's the one I'm going to be focused on the most. There are two other methods that I'm going to introduce, but I'm not going to give you a lot of work on these. One, so the straight line method, the most popular method, we're going to be looking at that first. A couple of others, one called a declining balance method. It's almost like an accelerated depreciation method that's used, but clearly not a lot of companies don't use that. And another method is to depreciate on a units of activity method. And so that truck, you could also depreciate that truck by the mile. That's a unit of activity. Or if I had a copy machine, by the copy. So the unit of activity is again, these two are very, very small in nature. The focus really is on straight line. So I'll be straight with you. Okay. So let's take a look at how it would work for Bill. Bill bought a small delivery truck for 13, small. I mean, I don't know, maybe there was a little, what does he wind it up to get it going? I'm not sure. Pulls a little string off the back of it to get it, I don't know, $13,000 for a truck. Ooh, that's dirt cheap. After which they think it's going to last them 5 years. So its useful life is in years listed here. After which it's only going to be worth about $1,000. That's the salvage value. If they looked at the useful life in units, they think they're going to need, they're going to get 100,000 miles out of this truck before it's not going to be useful for their business anymore. So it's asking us to compute based on straight line first, units of activity second, and a declining balance third. So we're going to look at each method for Bill's pizza truck. So the straight line method, basically the expense is the same for every year. And we take the cost of the truck, which is $13,000, subtract out the salvage value of the truck, which is $1,000. So how much of the truck are they going to use in the business? 12,000. That becomes the depreciable cost. You can only depreciate what you've used, right? You can only expense what you've used. And so this is going to be what they're going to use in value of the truck. How long are they going to use it? Well, they'll divide that by the 5 years. Straight line method simply divides it by years. So that means every year they have this truck, they will be able to depreciate $2,400 per year for 5 years. Okay. So how does it look? Well, if you're depreciating an asset for 5 years, what your book is saying is that's depreciating 20% per year, because 20% per year over 5 years is 100% of what you depreciate. So your book shows this method in the illustration. Assuming you bought it right at the very beginning of 2017, you know you're going to depreciate 12,000 of this asset over 5 years, which is 20% each year for 5 years. So the depreciation expense for the first year is 2,400, and the offsetting credit goes to accumulated depreciation. Okay. So every year you're going to make the same entry: a debit to depreciation expense for 24,000, a credit to the accumulated depreciation for equipment for 24. Did I say 1,000? I meant 100. 2,400. Okay. Well, the difference between the cost of the asset minus your accumulated depreciation is going to be something called book value. Okay. And so book value is the difference between what it cost you and what you have already accumulated in depreciation. After the first year, you've depreciated $2,400, so that's the accumulated depreciation on the truck. The truck cost you, remember, this truck cost you 13 grand. You've already accumulated 2,400 of depreciation after the first year. The book value of the truck is 10,600. That's $13,000 truck minus the $2,400 in accumulated depreciation after the first year. That's your book value.
Wait, how do we get to 13,000?
That was the cost of the truck. Let me go back to the previous slide. The cost of the truck is 13,000.
Oh, okay, thanks.
All right. So again, the cost of the truck, 13,000 minus the salvage value gives us the 12,000 that we can depreciate over 5 years, which is the same as depreciating 20% a year. Okay. For 5 years, that's 100%. So the cost of the truck is 13,000. Subtracting out after the first year, we're simply on 2017 now. You've only written off 2,400 in depreciation expense, so that's what's accumulated. In the second year, you're going to depreciate again, right? So at the end of 2018, you will have a accumulated depreciation expense of 2,400 and a credit to accumulated depreciation of 2,400. Your expense accounts clearly zero out after we close the expense accounts every year. We do not close asset accounts, permanent accounts. So if you've accumulated 2,400 for 2 years, your total accumulated is 4,800. So after 2 years, you've written the truck off for 2 years in a row. Each year, 2,400. So a total of $4,800 of this truck has already been expensed through depreciation. The book value of the truck is the $13,000 rather, minus the $4,800 you've already accumulated after 2 years. So the book value is $8,200 of this truck after 2018. Okay. Guess what happens in 2019? the same thing. At the end of 2019, this is a little bit messy here, you're going to do the same journal entry. Debit depreciation expense, credit accumulated depreciation for the 2400. The expense gets closed out, but all of it is in your accumulated depreciation account. So after 3 years, you have written off $7,200 of depreciation on this asset. The book value of the asset at the end of the 3rd year is $5,800, which is a $13,000 truck minus the $7,200 of accumulated depreciation, right? These 3 years added together gives us that. So the difference is the book value. After the 4th year, we do the exact same entry in the journal. Depreciation expense gets a $2,400 debit, accumulated depreciation $2,400 credit. Again, the expense accounts will get closed out. However, our accumulated depreciation shows that after 4 years of expenses, we have accumulated $9,600 of depreciation on this truck. That's all 4 of these years added together is the $9,600. You bought a $13,000 truck. After 4 years, you have expensed $9,600 of depreciation. The book value of the truck is $3,400 after the 4th year. In the 5th year, it's your last year, right? 5 years. You're going to make your final entry for a depreciation expense of $2,400 and accumulated depreciation for $2,400 after the 5 years. That's your entire life of the truck. Well, look what happens at the end of the year. You have already accumulated the $12,000, which is exactly what you said you would expense over time. So your depreciable cost of $12,000 will be the ending accumulated depreciation balance here for this truck. And the book value of $1,000 is exactly what you said the salvage value would be. The salvage value would be $1,000. The most you would write off is $12,000. And basically after 5 years, that's what this shows. Okay. What if you bought the truck in April? Remember, the $2,400 that we just looked at is an annual expense. Annual means all 12 months. But what if you bought it in April? If you bought it on April 1st, you've only had it that first year for 9 months. So you cannot write off the full $2,400 that first year because you didn't own it all 12 months. This is an annual expense. All 12 months are included in this. So if you only owned it for a partial year, in this case, April 1st would mean you've had it for 9 months of the 12 for that year. So you can literally write off 9/12 of this or $1,800 the first year. Okay. What about the last 3 months? This is a 5-year depreciation. Yes. The other 3 months will roll over into the following year where you can take the final 3 months of that. So in total, this is 1 year, 2 years, 3 years, 4 years, 5 years. Okay. Because these two equal 1 year. And these are the other 4. Remember, it's still a 5-year deal. It's still a 5-year deal. You can still write off the full $12,000 over that 5-year period, but just your 5-year period is going to end on a different date. So this is what we call a partial year depreciation. It only happens in the very first year that you bought it, and the remaining piece of that rolls over to the very last year. Okay. So if you bought this in July, you'd only be able to July 1st, you only have it for 6 months. So you'd have to multiply the full by 6/12, which is half of it. The other half would show up in the following year. You can still write off a total of 5 total years, but when you have a partial year, it rolls over differently. All right, that's going to be most of your work. Straight line depreciation. These are introductions. They're not emphasized all that much. You'll be getting a small taste of it in some very brief exercises, but otherwise, nothing big. The declining balance method is simply an accelerated method of straight line. And as you see in the straight line method, where that truck was being depreciated over 5 years, and so we depreciated the cost 20% per year over 5 years. The declining balance method simply is double the rate that we calculated for the straight line. So instead of depreciating 20% each year, we're going to depreciate 40% until the balance is gone. You can never depreciate more than what you said you were going to. So in our truck, we said we were going to depreciate 12,000 in total. That's it. We cannot depreciate more than 12,000, period, on this truck. So it doesn't matter what the rate is per se, you're still going to only write off the $12,000 in total. So how the declining balance method works is different, because the declining balance method uses the book value every year and multiplies it by double the rate of what we did for straight line to get an annual depreciation expense. So notice in the very first year when we bought the truck, the book value is the cost of the truck, $13,000. We multiplied it under the straight line method by 20%. Under the declining balance method, it's double that, which is why it's 40%. So in the very first year, we are going to depreciate $5,200 of this truck right off the bat. Okay. So our entry at the end of the year, if we use declining balance method, would be a depreciation expense of $5,200 and a credit to accumulated depreciation of $5,200. So that means that our book value of the truck after the very first year, we've written off $5,200 of a $13,000 truck right in the very first year. So the book value is $7,600. Should be actually $7,800. This is wrong. Should be $7,800. So $7,800 becomes the beginning book value for 2018. Multiply that by double the straight line, which is 40%. We're going to write off another $3,120 this year, and for that year for depreciation expense. When you add these two together, your accumulated depreciation is $8,320. Book value is down already to $4,680, really low. That becomes our beginning balance to calculate our depreciation here. Times the 40%, we're going to write off another $1,872. So look, after the first 3 years, we've already written off over $10,000 of this asset. That's the accelerated portion of this. Okay. Balance, book value is like $2,800. Multiply that by the 40%, we can write off another $1,123. So we've already basically written off most of this already. It doesn't matter in this case what the remaining book value is in the 5th year, because the only thing we can actually write off is the difference between where we're at in year 4 and the maximum we can depreciate, which, as we know, for this truck, $12,000 is where we said the maximum was. So we're simply going to write off the difference in the year, in the very, very last year, regardless what the difference is. Again, at the end of the year, the 5th year, the book value of the truck is going to be the salvage value. So notice how at the very end for accumulated depreciation and book value, we're still at the same numbers we started with. $12,000 in total depreciation over 5 years, $1,000 salvage value at the end of the 5 years. Those are never going to change. Okay. If we had a partial year because it was purchased on April 1st, we would do the same thing. So we would calculate the annual expense and multiply it by the partial year in the very first year that we bought it, which would definitely affect its depreciation expense for that particular year because it's a partial year. And the other part, we simply would write off at the very, very end. but it doesn't really matter because we can only write off the difference, right? So it works the same way. The units of activity method is actually quite simple because the first thing you need to do is determine what the depreciation cost per unit is. So for this example of Bill's truck, we said we were going to depreciate $12,000 of that truck, but the units is miles. So we're going to depreciate it over 100,000 miles. So every mile we drive the truck, we depreciate it by 12 cents per mile. So all you really need to do is figure out what your how many miles you drove the truck every year to calculate your expense. So 12 cents a mile times, in this case, the first year was 15,000 miles. Your depreciation expense is $1,800 for that year because you are using it by mile. That's the unit that you're depreciating it for. So again, everything is based on miles driven. Okay. Miles driven, in essence, has to add up to the total of 100,000 because that's what you promised you were going to use the truck for 100,000 miles. So you can't write off more than 100,000 miles over that 5-year period of time. The rate per mile becomes the marker in which we calculate our annual depreciation. In this case, we can still keep track of our book value, but for units of activity, it doesn't matter because we are not basing it on that. We're basing it on the number of miles that we drive. Okay. So that makes it a little bit easier. What's the choice that management have? Usually it's the simplest method. Straight line method is really the simplest method to use. It's the most consistent being used. And it's simply for financial reporting. Okay, what you see as depreciation on our financial statements is not what they use for their taxes. The tax method that they use is different than what they show us on the reports. And that's because the IRS and the law has a different tax proposal for depreciation for business equipment and things like this. So for management's choice, it really varies. As you see, no matter what choice they use, at the end of the 5 years, Bill's still going to be depreciating $12,000 of that truck. So straight line seems to be the easiest one. I think it's why it's the most popular. Okay. And like I mentioned, depreciation on our financial statements that you and I are reading is not the same method that the IRS requires. Okay, so the IRS requires the straight line method, or it has its own system called MACRS, Modified Accelerated Cost Recovery System. Is a depreciation method. Straight line method is perfect under GAAP. MACRS is not. So I think that's another reason why they use straight line. Okay, it's simple. It helps them with their taxes for those that continue to use it. I think it's just clear. You will see in the notes to financial statements that when each corporation talks about their property and equipment, they will go ahead and tell you what method they use. They also will tell you what the periods of time that they use things for. So here, this is Southwest Airlines. They are using their planes and flight equipment for 23 to 25 years. And some of their ground property and equipment between 5 and 30 years, depending. Okay. So they will list specifically what they do it, how they do it. Sometimes they do have to revise these types of things. And so roughly because there may be a change in estimate in the depreciation of an asset. Not much to worry about here in this case. I'm not going to keep you on that. I will, however, tell you about an impairment. because impairments are common, more common than you might think. Um, Sometimes there is a permanent decline in the value of an asset. And so it doesn't make any sense to keep the asset valued on the balance sheet at what they actually paid for it. They actually have to then use a fair value method to show what the real value of the asset is. So, for example, Disney makes movies in which they have um, each movie has a particular cost. It's their asset. It's their asset. What happens when they make a flop? Which hasn't happened in a little while, but what happens to make a flop? Well, they have valued that asset at a certain price, but in reality, it's not worth, it's not worth much. And so they will create an impairment. One thing that's happened a lot, and Disney that might not be the best example. Here's a better example. A lot of people have been purchasing stock in marijuana growing companies over the years. One of the more popular ones, because it was promoted on Robinhood, is Aurora Cannabis. And so Aurora went through a period of time a few years ago where they were buying all types of property, plant, and equipment. They basically were expanding their capacity to grow marijuana and process that. And then, of course, you know, that didn't come to fruition. The marijuana market did not grow just because we legalized it. There were still a lot of impediments to doing business, particularly in the United States, where it's still illegal on a federal level. Um, and so they overspent. They overspent on these assets, and they couldn't really keep it on the books as what they spent it on. So they had to write down the assets to their fair value and state, look, we paid $3 million for this growing warehouse, but in actuality, it's the real value of the asset is a million, not 3 million, and so we're going to write down the $2 million as an impairment. That happens. That happens a lot. Um, so that's something that you have to be um, concerned about. Okay. Well, I guess your book has a revised depreciation example here, so I will explain it to you real briefly, although you're probably not going to see many of these at all. Um, so when a company has to revise depreciation, that basically means that they changed the life of of the equipment, or the salvage value of the equipment has changed. Something has changed. And again, in depreciation, the cost, the useful life, and the salvage value are the three more important things, right? So something has to change in those categories for you to need to revise things. So here we have a corporation who bought a piece of equipment for $36,000 that they were going to use for 6 years, and they estimated that the salvage value would be 6,000. Thus, $36,000 cost minus $6,000 salvage value is a $30,000 depreciation. Divided by 6 years, $5,000 a year for 6 years. However, at the end of the third year, it estimated that the useful life is actually 10 years, and the salvage value is actually now $2,000. So you've already written off 3 years of this thing. And originally you had only 3 years left. Well, now you have more than that, right? You have up to 10 years. And instead of it being worth $6,000 at the end, it's worth $2,000. So the original depreciation was $5,000 per year. You have already accumulated 2 years of depreciation. So you've already written off $10,000 of this asset after the 3 years. After the 2 years. At the end of the third year, you have adjusted these issues. So now you have a $26,000 book value, but now you are going to keep it longer, and you have a salvage value of $2,000. And you're going to keep it for 10 years, so you got 8 more years to do on this. So the actual new depreciated cost is the difference. And because you're going to be keeping it longer, your annual depreciation is smaller, 3,000 per year. And so that's how they do the revise. So you're not going to see a lot of those. I just wanted to explain it because it's in your book. Lots of information on this one. I apologize. It is a heavy duty topic. And we're going to break it down so we can have a chance to work on it over the next couple of days and see how you do. But do bring your questions on Thursday morning.